Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The future of Star Entertainment remains in doubt with the company's shares suspended until it can secure financings to stave off collapse or otherwise. That might be some time before we find out exactly what's going on with the casino operator missing a deadline to finalise its accounts, having been unable to secure a rescue package. If Star Entertainment goes under, it certainly won't be the first listed company to do so. I wanted to take a look at why these big collapses happen, how regularly they happen, and what they mean for investors. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Damon Callaghan is Partner Investments at ECP Asset Management. Damon, welcome to Fear and Greed.
Thanks for having me, Sean.
So just very quickly, Star, I don't really want to talk about Star too much because it's on the brink, but when a company is on the brink for whatever reason, is it mostly about finance? Is it mostly about trying to find funding at the last minute?
Yeah, look, when they're on the brink, it's usually because investors have given up confidence in the ability of a certain business to sustain itself over the long run. You know, you can be a bad business and investors can, for perhaps the wrong reasons, continue to fund you and support equity raises until they ultimately learn that this business is going nowhere and give up. So some businesses last longer than they should. Whether or not now Star has, lost investor faith and will be able to recapitalise itself remains to be seen. But, Sean, I think you hit the nail on the head.
So you talk about equity raises there, but there's also debt financing. I presume at this point, for a company that's really desperate, it'll do anything. And I mean, equity raising, it's hard to go to the market and ask shareholders, that have bought in at $1 to pay 7 cents for a share. I suppose you've got to get some sort of guardian angel or something there. But is it mostly about debt financing at this point?
No, it's just about the ability to recapitalise yourself. So every business case is going to be different. But if you are, burdened by a lot of debt, then that's going to be potentially more or equal to the actual value of your business. So there might not be any value left for the pre-existing residual equity holders.
Yep.
So you have a recapitalisation. The debt holders' debt will convert to equity. It'll be worth, something less than the value of that original debt. But ultimately, whether that in and of itself will hold any value just comes down to the future owner of this business and whether or not they believe it can turn a profit into the long term. If it's a business that's going to burn cash forever, theoretically it has, no intangible value. It will be sold to pieces. I'm not saying that's the case with Star, but that's generally how these things go.
Okay, so we're just talking about Star, but more broadly, companies on the ASX do fail, don't they? And I'm not just talking about those at the bottom end of it. I mean, top 200 companies have failed over time or come close to collapse.
Yeah, look, so, obviously by the time you've gotten into the ASX 200, you have become a big business. And at some point in your life, you were a profitable entity.
Yep. And
so it's unusual to see businesses fail because their economics just don't work anymore. Things can change though. And Star, we don't want to talk about that, but it's just a case where regulations can change and change the sustainability of a business. And sometimes there are macroeconomic forces. So, miners can become very large when there's a bull market and commodity prices are high. But if you aren't a low cost producer, then your sustainability is a question. And then when ultimately commodity prices go down, you may not be able to turn a profit. And if that happens for a long enough period of time, you can run out of cash. Most of the time, though, in those rare instances that blue chip companies disappear, it can be due to poor execution from management and usually financial mismanagement. So taking on too much debt, going offshore into unprofitable ventures and blowing up cash flow, doing what Star's done with cost blowouts and developments in Australia that have added to their list of problems. And so, those management execution events can be the cause of demise, but it usually links itself to financial mismanagement, debt and then no room for equity value.
And then occasionally it's actually fraud. So HH was a good example, I think, in Australia where Ray Williams, who was the CEO back then, ended up in jail as a result. That's kind of a one-off, though. I don't know of any other examples of actually fraudulent behaviour as opposed to change in regulation or kind of unable to access finance or mismanagement as opposed to fraud. Is that right? Do we often see fraud is really my question.
Not in the ASX 200. But there are plenty of cases on the ASX over a long history of fraudulent from behaviour from management. I recently wrote a piece publicly, you can find it on our website, that talks about not quite fraud, but as close as to it as you can get, with a particular Australian small cap where they ended up having to rewrite all the historic financial accounts because of dodgy accounting practices. The consequences of that was the market no longer trusted management, and what might have had some piece of a viable business within it was completely written off by the market to be worth nothing. So it does happen, but rare in the ASX 200, Sean.
We'll take a quick break, Damon, and be back in a moment. I'm speaking to Damon Callaghan from ECP Asset Management. We have spoken about Star and we touched on HAH. You just mentioned a small cap. What about companies like AMP? It certainly didn't go under, but it, for whatever reason, shrank really quickly. Do many companies do that? I mean, that was a blue chip, ain't no more.
Look, again, in the large world, radical changes only happen when there are unsustainable practices that a business is exposed to. Take, for example, casinos, gambling, gaming machines, things that don't necessarily add value to society and, are waiting for a regulator to come and tighten the screws. So AMP specifically wasn't in an industry that's feeding off society, but they had unsustainable elements to their business that back in 2012 with regulatory changes to financial advice impacted the profitability of their model. And as industries change, usually due to unsustainable practices, as I've said, with regulators trying to tighten the screws, you can go from having a viable business to a business that finds it struggles to turn a profit and keep operating. And so one of the first things we look at when we're investing is how does a business make money from its customers? Is it adding value to society, adding value to its customers, or is it feeding off them? And it's a very simple way to sit back and try and think about the exposures that a business might have in the future. Because you can have gambling businesses, for example, that can be monopolies and large and profitable businesses, but you're sitting there in the best case scenario of regulatory settings that business is exposed to. Any changes from here will only make it harder. And you do not want to be exposed to businesses where you can look forward and theorize how things could be made a lot worse by factors outside their control.
Yeah. So is the flip side true? Is that part of the reason why the banks do so well in Australia is that they are probably the most highly regulated sector?
That's true. But once again, and this hasn't proven to be the case where competition has eaten into their profitability, but that is as good as it's going to get for the banks. The regulatory settings won't change to make competition harder for them. So if you're looking at how profitable they are, putting the macro cycle aside, it's probably as good as it gets at the moment.
So as an investor, if I am looking at a stock, what are the warning signs, do you think? I mean, you sort of covered them at the beginning, but as an investor, what are the warning signs for companies that are not necessarily going to go under, but certainly look like they're going to struggle to, be it finance themselves? What am I looking for? What are you looking for?
Yeah, Sean, I'll give you 4 really easy things that are worth stepping through for any investor as a starting point to just reduce your risk.
Mm-hmm.
I've already mentioned the first one, which is just thinking about
Yep.
the way they make money from their customers. As I said, are they adding value to their customers or are they feeding off them? And if they're feeding off them, it's just a business that's just not something you want to be exposed to. Their business model might be profitable today, but someone else, a regulator, the government, can change that in the future. The second thing that's very easy is the balance sheet.
Yep.
If you can have a quick look at the balance sheet and not understand it, and that can be the case for a lot of financial institutions, it takes a lot of sophistication and training and technical skill to be able to understand a bank's or a financial institution such as Challenger that sells lifetime annuities, just to be able to understand their balance sheet.
Yep.
If you can't understand it, put it in the too hard basket because you don't know what sort of leverage you're exposed to. If it's a clean and simple balance sheet, that's a great step you can pass through. If there's a lot of debt, then you have to start thinking about how much debt is there relative to the profitability of this company. The third thing is the cash flow of the business. So does the cash flow equate to the profitability of the organisation over time? So to be technical on this, over time, roughly the free cash flow of the organisation, so it's the operating cash flow taking away the capex, that should roughly equate to the net profit of the business over time. It won't be the same in every passing year, but if you're seeing enormous discrepancies, then you know that the accounting profit isn't worth a whole lot to you. It's not something that can be relied upon. Cash is usually king. And so that's the third easy element to pass through, is just looking for that consistency. And the last really easy one is management continuity. If there is a revolving door of senior executives at the top of an organisation, it's usually a sign that it's a floundering organisation There's a lot of instability within the ranks, and it's usually an organization that's not necessarily going backwards, but it's not going anywhere. It's not going to get bigger and more profitable through time, at least in the short term, and it's an easy one to avoid. If you just follow those simple 4 steps, you can substantially reduce the risk of being exposed to a lot of things. But that is just a starting point. Trying to figure out how to get exposed to compelling companies that are growing their profitability, and this is where we get to talk about quality organizations and how to define quality. That is a more interesting conversation from my perspective.
That will be the subject of the next podcast, Damon. Thank you for joining us this morning on Fear and Greed.
Thanks for your time, Sean.
That was Damon Callaghan, Partner Investments at ECP Asset Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before investing. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.